The best investing strategies for inflationary times. We're going to go over what Larry Swedroe over at Buckingham Asset Management has concocted. A big fan of Larry, and this is a good article. And it's somewhat illuminating that there's not much you can do to avoid inflationary chaos. And it just is what it is. So let's dive into this. So here's my man Larry. He talks. So this is data just in April of this, April 14th of this past year. Let's see. Studies such as the best strategies for inflationary times, published by the Journal of Portfolio Management, have found that TIPS perform the best hedge against inflation, with similar positive real returns in inflationary and non-inflationary times. So we're going to write that down. We're going to say TIPS because a lot of people say, I'm investing in TIPS. Because we're going to also look at what happens with TIPS when there wasn't much inflation, because I think that could lead a lot to be desired here for sure. Despite the conventional wisdom by many investors that stocks provide some protection from inflation, equities tend to suffer from less stable economic climate. And costs tend to rise with inflation more than output prices, which of course would affect earnings. I don't buy this 2 seconds flat. Stocks are a hedge against inflation any more than anything else is. And the reason is because stocks, the companies that are the stocks, have to deal with their own inflationary measures. And i.e., that means reduced earnings. Reduced earnings hurt stock prices for sure. And that could potentially affect dividends too. All right, so, but be it as it may, I mean, over stocks for the long term. Okay, look, I believe in the capital markets. I just hear these things, stocks for the long term. I get it, but in the long term, we're all dead. And the stock market can be irrational longer than you can be solvent, if that makes sense. And such, it's kind of like you just can't say, well, this is what happened before thus. It doesn't make sense to me. It never has. No individual equity sector, including energy, offers significant protection against high and rising inflation. Commodities provided the best historical performance against inflation. However, in all other periods, the real return was just 1%. That is net of inflation. So right now, commodities are kicking butts and taking names. But if you've been in commodities for the last 10 years, you're not in a good place. Residential real estate underperformed during high inflationary times. Now, notice he says high inflationary times. So what exactly do we define as high inflationary? I don't know. Residential real estate, in my opinion, is one of the best bets against high inflation. That's just, I can't say it's a fact, but just because high inflation means higher prices, and that such means that it's going to be, you have a place to live. If you have no mortgage on it, your place to live is essentially free except for property taxes, all right, and homeowners insurance. Whereas the protection against inflation is if you're in a rental place, inflation could make your rents go higher. So residential real estate for which you own is certainly a huge hedge against inflation. That's not debatable in my opinion. Collectibles provided strong real returns during inflationary times, but weaker than commodities. But they didn't do much in other return areas. Cross-sectional momentum was the best performer during inflationary regimes. But what the hell? No one knows what cross-sectional stock momentum means. I mean, I guess someone could define it, but try to follow that. You can't. And then you're going to pay some guy, I'm going to follow cross-sectional momentum strategies. Kind of like, I'm going to follow the David Swenson Yale endowment model. All right. Equity factors with negative realized annual returns during high inflationary times. They just look at various factors: profitability, value, low volatility. None of them did much relative to inflation. Basically broke even a little bit less than breaking even, but it wasn't like you got smoked. Times trend falling. Okay, so that's fine. So the bottom line is that the best inflation hedge has been TIPS, with commodities also tending to do well. However, because commodities tend to provide poor returns in all other periods and can experience very long periods of poor returns, they should only be considered by investors with discipline to stick with the strategy. I completely agree, because most people cannot stick with the strategy other than a year to 3 at most. Neither stocks nor nominal real return bonds nor residential real estate have provided a good hedge against inflation. Well, we just talked about that. Here, gold as an inflation hedge. This is not, I've always said this isn't true. On January 21, 1980, the price of gold reached a then high of $850. On March 19, 2002, gold was trading at $293, well below where it was 20 years previous. The inflation rate for the period was 3.9%. Thus, gold's loss in real purchasing power was 85%. How can gold be an inflation hedge when over the course of 22 years it lost 85%? I completely agree. Now, somebody will say gold would be able to buy you a good suit. Look, I get that. I mean, that makes inherently sense. That's a good way to look at it. But I don't know what a good suit was paying, what it cost in 1980. But if you got a thing of gold in 1980, you paid $850 for it. You're paying for a good suit. You're paying theoretically $293. All right, so I mean that doesn't make any sense. So was a good suit cost $850 in 1980 or $293 in 2002? One of those things is not right, and so you have to say, well, the price of a good suit cost $293 in 1980 and $850 in 2002. Well, then gold wasn't a hedge against inflation. The price of a good suit cost $850 in 1980. I don't think so. That seems extremely expensive versus $293 in 1982. It just, you can't say gold is a hedge against inflation. I just did a video a couple days ago on why you invest in gold. Alternative fixed income strategies, stay away. And I guess that's pretty much it. All right, so let me show you a couple things here. Here's the Vanguard Tips Fund, and it goes back to 2001, January of 2001, right there. And we're going to see, we're going to dump $10,000 in. We're not going to do anything in terms of right now. We're just reinvesting the interest and dividends. It's not really dividends, but you get it. We're reinvesting the income, I should say. And we're going to see where we're at. So Vanguard Tips Fund, after 20, a little bit more than 20 years, we put $10,000 in. It's worth $27,000. All right. Compounded annual growth rate of 4.8%. All right. Max drawdown 12.5%, which is actually higher than Wellesley, if memory serves. All right, so let's adjust this for inflation here. We'll compare it to inflation. I think I can do that. Where do I do that here? Right here. So we're going to click on inflation adjusted. And after inflation, you're at $16,000 after starting $10,000 in 20 years ago. So let's take our trusty calculator. We're going to say we put in $10,000. All right, it's our present value. We're at 16,000. We'll say 500 just for simplicity. 2001 to 2022, that's 22 years, right? 2001, yeah, because that's 2001, 2, 3, yeah, 22 years, and zero payment compute. Oops, I got it. 1 second. Blank. We got to change that like that. We got $10,000 plus minus blank. That's a 2.3% real return. I mean, that's not bad. 2.3%. I mean, it did keep up with inflation. That is a fact, Jack. 2.3%. Compounding annual growth rate was 4.8, so we lost about 2.5 to that to inflation. So I mean, you did keep up with inflation. That's just a fact. You had some down years there. Down here in 2022, we're down 6% so far. That's interesting. 2008, we're down. Oh, it's weird. 2008, there would be down 2. That's interesting. Well, because there's, I guess, deflation. I guess that's what caused it. Anyway, not too bad. We'll take that. But just again, we'll compare it to Wellesley Fund. B Winks, and right there. And we're going to go right here. And it's not a fair comparison, people say. Sure it is. And we're going to look back because Wellesley goes back to 21 as well. It also goes back to 1970, to be perfectly honest with you. So there's Wellesley. Net of inflation is $40,000. Max drawdown on Wellesley was higher than the tips, significantly, about 50% higher. Worst year is roughly the same, but the max drawdown, if you're pulling money out at that time, was significantly higher. But you can see right there, net of inflation, Wellesley has dominated the tips. Not as much as I would have thought. It has. Let's just compare it to, we'll just do VFINX, and we'll just see what that guy looks like without any bonds in there whatsoever. We'll just do this and just get a gauge of what stocks have done. Yeah, look at that. So stocks net of inflation, 46,000. This is why I love Wellesley, man. Look, Wellesley is closer to the S&P 500, and yet Wellesley is about a little bit more risky than the tips. I can't stress enough why I love Wellesley. Anyway, point being is, we're going to take some money out of this portfolio, 500, and let's do $400 a year, cash flows. That'd be a 4% withdrawal rate, and see how things shook out. Shall we? Shall we? Yes, we shall, because I'm in control of my YouTube channel until they ban me, which is inevitable. All right, so if we're taking 4% a year out, all right, let's see, 4%. What's this guy? Wellesley. Look at that, man. Cheese, Louise, and blue cheese. Wellesley is still the best fund. I mean, I'm gonna write a book on Wellesley. Look at that. S&P 500 is at 11,000. Tips were better than S&P 500, but Wellesley beat them all. Now, that's for 22 years. Will it happen again? I have no clue, my friends. No clue whatsoever. But this is this right here is what scares me the most. That first 10 years of retirement. Look at that. 61.84% was a max drawdown. That's including cash flows. You're taking money out. That's freaking nuts, man. Jeez. I don't know what to tell you, but that's not even inflation. Let's do inflation adjusted. Oh my goodness! Look at inflation adjusted. You're pulling money out. S&P 500 is worth $6,800. Wellesley is worth $11,000. So even pulling money out at 4% a year, Wellesley is still in the black. Where both those other things are knee deep in the red. What else? All right, that's fantastic. So let's just do the last 10 years. Let's just do the last 2 years and see. 20. Let's do last. I just want to see because this is when the inflation really kicked in. Let's see what we got here. So $10,000 invested in tips is worth $9,500. $10,000 invested in the S&P 500 is worth $11,000. This is not net of inflation. Let's do net of inflation. Yeah, so net of inflation, S&P 500 is basically breaking even. Wellesley's down about 11%. This is pulling 4% a year off, by the way. Tips are down to 85.96. The issue is if you're pulling money out, the tips are not going to, it's going to be tough to stand the test of time for any significant time frame. That's crazy. All right, so let me show you. I'm going to do part 2 of the video to show you my best investment against inflation. I've done this before. I'm going to do it again. So hang tight.